Howdy, everyone. It's Darius Dale here, 42 Macro, and I have the great pleasure of sitting down with Steven Van Metre, aka the Bond King. Steven, how you doing?
Hey, buddy, it's great to be with you today. I'm really looking forward to this.
Yeah, same, man. Absolutely. I'm really looking forward to figuring out where this nickname came from. I love it. It's hilarious.
Yeah, the Bond King. So, when I started the YouTube show, macro is a pretty boring topic. I mean, there are people obviously that like it. That's why they're watching. But when you're doing a YouTube show, the idea is you've got to appeal to people who are scrolling through, kind of like Facebook or the videos, and to get their attention. And boy, it's a tough subject. And so I thought, how cool would it be to make this fun? And at the time, I started looking around at people who were really good at marketing and creating brands. And you start going like, all they did was pick something and then run with it. And so I said, okay, I have my macro thesis. I'm bullish on bonds. I'll call myself the Bond King.
I love it, man. It's great. So I take it you're out in California, right?
Yes, absolutely.
I take it. I take it you haven't been roughed up by Mr. Gunlack's henchmen at this point.
No, I have not gotten any henchmen or the illegal notices about using the term Bond King, which I'm almost somewhat surprised because the media obviously uses it with Jeff Gunlock, but he doesn't use it as a branding piece. So, and I'm pretty sure he doesn't know I exist at this point. So I'm okay.
No, it's all good. It's all good. I've been in, been in meetings in that place. I'm still pretty sure he still doesn't know I exist, so it doesn't matter. So let's obviously that's not why we're here. We're here to kind of talk about your views on the economic outlook and how they ultimately dovetail into your recommendations with respect to asset classes. So you and I were prepping last night, and I thought this should have been the number one topic we really dive into. And really, it's just the supply and demand imbalances in the labor market and how you see that impacting growth on a go-forward basis.
Yeah, that's the great thing that we started to talk about is you have this confluence where the fiscal stimulus is going away at a time that, the labor market is just struggling. And the broad view is real simple. You've got, roughly 11 million job openings according to the JOLTS. Whether you believe that number to be accurate or not, that's what the government reports. We know for a fact there's around 8 million people, give or take, that came off pandemic unemployment assistance. And the belief is really simple, is all these people are going to go back to work. And I was kind of suspect about that. And so far in the data, we're not seeing that. In fact, we're seeing in the interviews from people that are off work is a lot of them don't want to go back to work. They don't want to go back to that job if they do go back to work. And we're still dealing with pandemic issues in terms of childcare, and this is a big issue. With my wife being a fourth grade teacher, you see infections get into the schools, and if people don't believe this is actually happening, I mean it's real, and to the point where if a kid is even believed to have it, an administrator will walk in with a large ruler and say, okay, you are all going home and you are all going home. And this is a huge burden on parents because they don't know one day to the next if they can work or not. And so I'm really curious to see if all these people will go back. I'm not convinced they will. And I think that's a real challenge because that's the big view is they're all going to go back. They're all going to have higher wages and the economic boom is just getting started.
Yeah, so let me put some numbers on that for the audience. By my math, I have about there's 7 million
is just getting started.
Yeah, so let me put some numbers on that for the audience. By my math, I have about there's 7 million people out of work due to the pandemic. When you add up the additional 2 million unemployed people off the February 20 low for unemployed workers, and then you have basically 5 million people have dropped out of the labor force relative to where it was, and it's February 20 high. And so, the real question, I think you're getting to the right of the matter here, which is what are those 7 million people going to do, right? Like, are they retired? Are they just done working, and do they no longer have to eat or pay rent? And because I certainly can see the other side of the debate, which is the second we get better vaccination efforts out with respect to school age children, you could see a lot of people sort of return to the labor market. What are your thoughts on that?
Yeah, I mean, I think people will want to, for sure. I mean, and I want to be clear, and you and I talked about this yesterday, is I don't know if I'm right or wrong. I'm just afraid that if people don't go back to work, we're going to have a massive air pocket in the economy going through the holiday season, which is absolutely critical. I mean, you see it's in the Biden administration. I mean, they're pushing to get all this stuff out of the ports because they know somebody in his administration knows how important the holiday season is for consumers. And what do they need? They need money. And you start going backwards to this whole notion that we're going to have this massive economic boom going into the fourth quarter and into next year. And I keep looking back to the rearview mirror and said, where did all these people get their money from? Oh, government stimulus. Yeah. It's gone. And so I think the question is, how much money do they have left? And I know we saw reports from Bloomberg. I don't know where your data suggests, but there's still around $2.7 trillion in pockets. Is that money being saved because they're not sure when they're going back to work? I mean, what's really going on? And I don't think we know. And that really concerns me that we don't know.
Yeah, I think you hit the nail on the head with respect to the phrase air pocket. I think I think it's very clear that the economy hit an air pocket as a function of Delta, and we can see this. You know, you got auto sales, they're contracting at a 57% annualized pace in the month of September. Industrial production yesterday contracting at a 14% annualized pace in the month of September. You keep this up, we're talking about recession. You know, I think it might be premature to have that discussion. Maybe the next time you are ironed on, Real Vision will be actually unpacking that. But the reality is we've already hit an air pocket economically. I think going back to the labor market, one of my favorite indicators that I've been looking at throughout the pandemic is really just the labor force participation rate for prime working age adults, those are 25 to 54-year-old individuals. And that actually ticked down 10 basis points in the most recent jobs report, the September jobs report, to 81.6%. The reason I call that out, one, it's down 140 basis points off the Jan 20 high. So that's a great sort of a microcosm of the reduced labor supply out there for individuals who otherwise would and probably should be working. But the reason I bring that up with respect to the air pocket is because you actually might have that air pocket get filled with hot air. And I don't mean hot air from a growth perspective. I mean hot air from an inflation perspective. You go back to that same jobs report. One of my favorite metrics to track in the pandemic was average weekly earnings, because obviously average hourly earnings are dealing with their own compositional issues. And average weekly earnings accelerated 100 basis points in the most recent month to 5.9% on a year-over-year basis. So we're seeing the supply-demand imbalances really start to give way towards higher inflation and lower growth in real time. And so ultimately, it's really just, how do these issues resolve themselves? How do you see those issues resolving themselves?
Yeah, I think you've hit something I find really interesting there with wages going up, and and we've seen this with labor strikes now, and unions, saying, hey, you're putting out record profits or pretty big numbers, and we want our share. And it gets interesting because you're right. We're seeing the numbers go up. Employers are being forced to increase wages. Now, the question is, what do you need to reinforce those wages, right? You need spending. If I'm a small business, I just give everyone a raise. Well, I better hope that, when I open my doors tomorrow, there's a line of people out there. And that's where we come back to this whole drop of the fiscal stimulus. Now, I know some people are going to say, well, but Steve, what about the child, tax credit? Yeah, it's elevated. I mean, Darius, you could probably, give us some hard numbers on that. But, the data is actually showing that that money is really going to food inflation, energy inflation, into actual needs for the child. And so in some sense, people are getting more money, but it's getting absorbed by higher prices. So it's not having the follow through effect. And I think that's where I look at these higher wages is, the people that are working are making more money, and God bless them because they're working. And we when we go to a restaurant, we can see it on their face. They're stressed. My wife and I went out to dinner, I think a week ago, and they were just slammed. Or maybe I went to pick something up. I can't remember. And I said, man, you guys are hopping. The guy goes, it's not a good thing. We're short today. He's like, I wish some of these people would go home. And I think that's some of the issues. We're seeing people out there working, making higher wages. But when the supply of labor, these 7 million people you mentioned, when they come and start to apply for jobs, will that put downward pressure on price, or will employers feel they're forced to give them a higher wage as well?
Yeah, well, I mean, this we know economically, wages are the stickiest thing in the entire business cycle. They typically peak from a year-over-year rate of change perspective well into recession, and this is going all the way back to data through the early '60s and '70s. So that's pretty consistent dynamic. So, in terms of answering your question, I certainly don't expect wages to go down. I mean, the reality is the only way to sort of ameliorate a supply-demand imbalance is either to increase supply or reduce demand, right? Like this, or vice versa, depending on the setup. But certainly in this particular circumstance, it would argue that look, the people probably were holding out for better jobs and better opportunities. But something you and I talked about last night, which is, do they really exist? And where's my tin? I need to get a tin foil hat, to match your crown. But like,
Yeah, I'll loan you the crown.
yeah, thank you. No, it's we see these record job openings, right? So you look at the JOLTS data. Just I think it ticked down to 500,000 to around 10.4 million in the most recent month. I think it's August, and you still have things like job openings hard to fill, still up at a cyclical all-time high actually. Fewer no qualified applicants for job postings. That's in the NFIB Small Business Optimism Survey. That's at an all-time high or just shy of it. You things like compensation plans, at cyclical highs. All these things are going up at the same time. Where if you look at the actual broader survey, the headline ticked down the most recent month of September. The CapEx plans ticked down, hiring plans ticked down. This economy is really in a weird spot. And I think we don't want to make too much out of what's going on because clearly we saw a pretty meaningful sort of uptick in community transmission of COVID, obviously in case counts, hospitalizations, all those dynamics that really put a damper on consumer sentiment and really business activity in the third quarter of this year. And so, the real question I think for asset markets and market participants broadly is whether or not all those negative dynamics have a positive resolution here in Q4 now that we are clearly on the other side of the impact of the Delta variant. Your thoughts on that?
Yeah, I love the question of do these jobs exist, because it was first brought to my attention by our mutual friend Jeff Snyder, who was digging into the JOLTS report and kind of making fun of it. And I think one of the great things there is about having a YouTube channel is you have this broad, diverse audience, and you can put questions out to them and say, hey, here's what I think about this, but I'm not sure. And then next, your email box, hey, let me tell you, but what the truth is. And on the jobs thing, I got so many comments about this. I remember a few people said, hey, I've been at my company for a long, long time. We've always had this certain job opening. And my entire time here, we've never interviewed one person. As far as I know, it's always flown. We never look at anything. And then that went to people that worked in HR and in hiring, said, yeah, my company perceives job boards as a form of advertisement, and they don't want to be not be on there when their competitors are on. So what they will do is they will run jobs across every aspect of the country, every state, every county, every city. And even though we're not actually hiring for that job, it's kind of like Coke versus Pepsi. Pepsi's hiring. We don't want people to think that Coke is not, right? So we're going to have our jobs up there. And then it got worse. I had some people say that, hey, I work for a recruiting firm, and here's the real truth is a lot of these jobs that you see posted in the US are really being hired outside the country. And a number of them said, hey, I work for a recruiting firm in India, and by federal law, and this blew me away there, it just totally blew me away. We're required to post a duplicate job in the United States. We're required to collect applications for it, even do some interviews, and we package it up and we go to the employer and say, do you want the $7 an hour person or do you want the $20 an hour person? It's like, we can tell you which one they always pick, but by law, we have to run that job. And so the answer I got was, hey, that number on the JOLTS, it's totally bogus.
I mean, I've long thought it was totally bogus, but now that you said that, I mean, geez, should we even be looking at this data set? I mean, the only value at this point, now that you said what you just said, in my opinion, in the JOLTS survey is really the quits rate, which accelerated to an all-time high of 3.3% in the most recent month, August. And obviously that has positive implications for the forward outlook for things like the employment cost index, wages, median wages, things of that nature. But the reality is, we clearly have a tight labor market, as evidenced by the number of people who are willing to quit and look for for alternate means of employment. But we also have a less tight labor market than I think a lot of investors believe, as a function of, kind of reviewing data sets like the JOLTS. I'll tell you, I have my own anecdotal story. I kicked the tires on an alternative data provider that looks at, that aggregates job postings data by firm and by industry. And one of the things that he mentioned or the salesperson mentioned in that process was, a lot, we sell our data to a lot of buy side firms who are looking at software, companies, high flying, high multiples type software companies, and saying, hey, look, this jobs data, particularly on the developer front and sales front, will tell you whether or not, where a company is in its cycle and how competitive it might be relative to its competitors. And I was like, this is some pretty important data. If you're kind of playing that game, and then you take a step back, like, what business isn't playing that game, right? It's so like every business in America is effectively incentivized to inflate the number of job postings that they have at any given time. So that certainly that tends to agree with your sentiments as well.
Yeah, maybe one thing I'd like to get your opinion on is, since we're on topic of the JOLTS, is before the pandemic, there were 6 million openings. That wasn't driving inflation. It wasn't really pushing wages higher. And, maybe that lends some credence to the fact that maybe it is kind of bogus. Do you have any thoughts on kind of where it was before the pandemic and what that meant?
Yeah, I mean, so I think it's really just a function of two things. One, what's the total number of job openings relative to the total number of unemployed people who are in the labor force, designating themselves as unemployed because they are actively looking for work. And so right now we're clearly there's way more job openings than unemployed people. Roughly 2.5 million. So that's a big gap right there. That number was right around equal prior to the pandemic. So a much more fluid and tight labor market from that perspective. But I also think there's a skills mismatch as well. And I don't necessarily mean just purely technical skills. I think technical skills is the 90%, the 8,000-pound gorilla in the room, if you will, with respect to the skills mismatch. And unpacking that for a quick second, you think about work from home or hybrid work from home, or just trying to grow a business at all in this sort of post-pandemic world, or in this new normal, if you will. It's a lot harder to train people. You almost need people to come with the prerequisite skills to hit the ground running and get it going, because you're not going to have that one-on-one face-to-face time that you typically need to train someone to how to do things that incorporated XYZ or XYZ Incorporated. And so I think that in and of itself is a governing factor on how quickly the labor market can recover, because again, we're all looking for the same talented individuals, increasingly so, with less willingness to train them, and ultimately that just shrinks the overall pool of applicants relative to that big job openings number.
Yeah, I think the skills mismatch is really interesting, because what I'm seeing is a lot of my boomer clients obviously are retiring. That'd be true for anybody. And some of them have been at different employers for decades. I mean, if you want to talk and speak about institutional knowledge, I mean, they know where every bolt and screw's at. They know every customer. They know what they like. They know everything. And so you start looking at what these employers are flagging for jobs is these boomers are leaving. The employers are begging them to stay. In a lot of cases, they'll say, well, maybe I'll consult. And then you see the job posting later, they're literally wanting to hire back that exact person. And so someone young coming in, they don't have the skill set. And even if they try, what I'm hearing from my small business clients is, look, I'm having to work now more than ever, because my key employees that effectively ran my business are gone, and I can't replace them. It's like, and guess what? You're not, because they don't exist.
I know a thing or two about that. Anyway, keeping it moving. All right. So next topic, you got your risk of persistent stagflation. And this is something you called out in your recent video with respect to energy prices and heating prices and sort of the potential hit to consumer balance sheets and ultimately the income statement as a function of that. Talk to me about the sort of risk to the economy in Q4 specifically as a function of those dynamics.
Yeah, that's a great question. So you're seeing, we know energy prices are up. We know that's going to transmit into, electric prices are going to go up, gas prices for consumers as we hit the winter months. And so you start looking at overall, I view the financial conditions are relatively tight. I know a lot of the data metrics say the exact opposite, but from a monetary perspective, I see that financial conditions are tight. And so now again, we're back to the fiscal stimulus gone. We know people aren't back to work now. Now, who knows? Maybe there's going to be a 7 million NFP print, and everyone's back to work right now while we're filming. Maybe that's going to happen. Don't know. But you start looking at budgets for consumers, and how do you really drive inflation? At least the way I look at it is, it's not just food or energy or housing. Is I need someone to take their discretionary money and go spend. And what's going to happen is their budget is not only just been impacted by the lack of fiscal stimulus, but now they have higher cost of energy. To me, that's going to lead to less spending and ultimately a turnover of inflation as inventory starts backlogging onto shelves.
Oh, that's interesting, huh? So you're saying, if I can summarize, and maybe correct me if I'm wrong, we get a cost push shock to incomes and demand that ultimately gives way to a disinflationary outlook, on the other side of that as incomes ultimately don't recover. Is that am I summarizing that correctly?
You got it. And that's kind of one of the things that I think a lot of people don't understand about inflation and monetary policy. So if you have rising prices, the belief is that interest rates must rise and it's going to continue, that we're now at the beginning of this 40-year secular rise in inflation and interest rates. But in order for prices to go up, and I think this is where a lot of people would be benefited if they worked at a smaller mid-sized employer, because you see this more on a day-to-day basis, but you can price your product anywhere you want. But at the end of the day, if nobody comes in and buys it, then your price is wrong. And so how do I, as a consumer, able to afford that higher price? Well, I have to have my wages growing, or I have to have fiscal stimulus. I have to have some means to go buy that. But if my budget's being impacted by things I can't control, higher food prices, higher energy prices, sure, I can turn the thermostat a little bit, but in the end, I'm still going to have higher expenses. Then I have less money to go buy those consumer goods. And I think that was something that showed up in the retail sales. I don't know if you were looking at that, how close you looked at that, but the number was up, but it was up not in terms of actual goods, but it was in nominal terms due to inflation.
Yep. Yeah, and I mean we're continuing to see similar trends with respect to the leading survey data. You mentioned you love the University of Michigan survey because it has a lot of compositional sub indices that are pretty instructive and colorful at various points in the cycle. And right now, it's very clear when you look at something like the consumer buying intentions for large household durables. That number ticked down 88 in October. That's the lowest we've seen since last April. The intention to purchase vehicles is 57. I mean, that's the lowest reading we've seen since January of 2000. So consumers are certainly feeling the pinch of the not only just the lack of supply of certain items. You're talking about a kitchen remodel that you get your name on the book for 18 months from now, or you're trying to buy a new car or a used car for your kid or your wife or things of that nature. And it's just hard to do because, one, there's no supply, but two, the lack of supply is obviously creating some pretty lofty prices. And you're seeing this now, right? So I've been in, people who follow me, I know that I'm in I'm in a weird spot on inflation. I'm in the transitory camp in rate of change terms. And what I mean by that is, you look out with respect to our bottom-up projections, both for the U.S. economy, for most economies in the world, and inflation will be much lower a year from now. Like, there's no question, or not, sorry, there is plenty of question about that. But in terms of the probabilities associated with those forecasts, it's a pretty narrow band of outcomes that all point down in rate of change terms over the next 12 months. However, in levels terms, and what I mean by in levels terms, inflation is likely to be persistent. We're not going back to the lows of the prior, few inflation cycles. I continue to say that, the stationary mean of the inflation time series, at least especially in the U.S. economy, have transposed themselves higher, probably about 50 basis points for core PCE and core CPI, probably about 100, maybe even over 100 basis points for headline CPI and things of that nature. And you're certainly seeing evidence of that in the most recent data. You look at the CPI report for the month of September, median CPI, which obviously lops off all the stuff that's super volatile and moving on the tails, and obviously very impacted by the pandemic and things of that nature. But median CPI on a month-on-month annualized basis ticked up to 5.6%. That's the highest seasonally or season adjusted annualized rate of median CPI we've seen since I want to say August of 1990. That's a long time ago. So there's clearly firm inflation pressure in the economy, and it's broadening out with respect to goods and services. And so the reality is okay, when does the market really get spooked by that on the bond yield front? But I'm not actually so sure that that's the case, because what it ultimately means is we're going to have to start tightening monetary policy sooner. We're going to start tightening monetary policy faster, and ultimately the forward outlook for growth on a medium to long-term basis actually starts to get impeded by that.
Man, you struck so many chords that I don't even know where to begin.
I'm a chord striker, man.
Yeah, you. Oh man, I got to take some notes about the things that we need to talk about here. But one thing that I find interesting is, and we can go back to the financial crisis and look at where high energy crisis led to actual outright deflation. Of course, no one then even remotely thought that was going to happen. Mm-hmm. And one thing I think I want people to understand is, you can have higher prices in one part of the economy, and if monetary policy is too tight, which it is, and how do you know that? You can look at things like the money supply, and you can see the M2 growth is really slowing down now from where it was before. You can look at the money multiplier, which is the money supply divided by the monetary base, and see the negative impacts of quantitative easing and tight financial conditions. So, where I'm going with this is you can have high prices up here. So you can have high food prices, high energy prices, but it must be offset by lower prices somewhere else. And I think that's the part that people miss. They just assume that, all prices are going to go up. Again, in some people, they've never been poor. And I think if you've ever been poor and you go to the store and right, see, you understand, brother, right? And you go like, well, I got to feed the family tonight. And you open your wallet and you're like, well, this is all I've got. And I somehow got to come home with enough food, so, wife and I can make dinner and feed the kids. And if you're wealthy, it doesn't matter. You just go down the aisle and you buy whatever you want. But when you're poor and you have a limited amount of money, you start making substitutions and you start thinking, well, instead of buying the high-end version of this that I like, I want to buy the lesser version of this. Or maybe instead of putting this in there, we're going to skip out on that. No, the kids aren't going to like it, but hey, their bellies are going to go to bed full tonight. And that's the part that people miss. And maybe part of this is just because the stock market is up, that people aren't going back to work because, they think they're going to, be rich from stocks going forward. But the bottom line, I think that when people need to look at inflation, the bottom 50% of the population is not benefited from anything that's gone on. They've been given a bridge through fiscal stimulus, and they're hurting. And they're going to go to the store, and they're not going to be able to buy what they're used to. And ultimately, as all this stuff comes off these ships, it's going to pile back up on shelves, and everyone's going to shake their heads and say, why isn't it moving? It's simple. People can't afford it.
Yeah, no, look, there's a hierarchy of that trade down, right? Speaking from personal experience here, you go from eating real fruits and vegetables to canned fruits and vegetables. That's the first step. The second step is boxed cereal to bagged cereal. And then the last step is Hamburger Helper to whatever the hell the store brand Hamburger Helper is. And then there's no more trading down after that. You're in line at the food bank, as I have been many times. But at the end of the day, you're absolutely right. I mean, inflation obviously roils the sort of lower income cohorts of society. And this is something that, I would argue it's probably part of the reason that, President Biden's approval rating has plummeted so low. Obviously, the Afghanistan debacle was a big driver of that. The resurgence of COVID was another driver of that. But I think underneath the surface, consumers, whether you look at the Conference Board or the UMIS survey, even the Langer, the one that's been the best one, is not necessarily looking so robust. Consumers are kind of telling you that, look, man, I don't like all this inflation. The economy is much better where you can sit at home and work from home at a 2 to 3% inflation rate, but it's a lot less cool and kosher when it's 5 to 6%. Am I not correct there?
Yeah, and I think business owners are kind of in a pinch because they're forced to go out and put in a bunch of orders to get supply. I mean, and maybe that's driving the new orders to some extent, is they're putting in multiple orders, not knowing where it's going to come in first. They're being forced to give people higher wages. They're being forced to flag for jobs because they don't know what's going on. And their risk is, what if people stop spending because they don't have the money? And that is the, if I could put a big question mark on things, that's the one for me, is what happens when they I mean, I know what happens if they stop spending. The question is, do they stop spending? We don't know yet. But I mean, on a non-seasonally adjusted basis, you saw the retail sales was down 3.9%. Talk about a nice move up to 0.7 on a seasonally adjusted basis. But if that trend continues, they can only seasonally adjust a bad number up so many times in a row.
Yeah, no, definitely. And look, again, I think it's way too premature to be talking, R word talk, recession talk. But I think, in terms of having gone through now a couple of them, sitting in the seat, they're rarely as obvious, right? Well, I guess last year was very obvious because we shut the economy down willingly. So that was pretty clear and obvious. But, typically what happens is, there's a lot of negative economic data. And then they start when you 2-3 months forward in time, you look back and like, oh man, they revised that down a lot. And they revised that down a lot. And they revised that down a lot. And you wonder if we're actually kind of in this little moment here where that's the case. Again, I think it's way too premature to have that conversation and go down that road with respect to recession. But I do believe it is appropriate to put that now on your whiteboard as an investor. Like it should be somewhere, maybe not, as big as stagflation or, bond yield. There's all these other themes and topics right now. COVID obviously still is very present on the mental whiteboard, but I think recession needs to occupy a space there. Don't you agree?
Oh yeah, because look at high crude oil prices. I mean, what was it that busted up the great financial crisis? I mean, crude oil prices just went ridiculous, and look what's happening now. Crude prices are going up again. If I'm out trying to look for a job, I got to get in my car. I got to go to the gas station. As much as California's trying to make everything electric, it's just not going to happen where we have this abundance of free electricity to drive around in our electric cars. The reality is these high energy prices cannot be avoided by consumers. It broke the economy back in was it 08 or early 09, whenever it peaked. I know you've got the exact date on that. And here we're seeing that again. I mean, in fact, to me, what we saw leading to the great financial crisis with interest rates kind of pushing up and then getting rejected, crude prices going up, wages going up. I mean, it's to me, it's almost the same thing, Darius.
Yeah. Look, so two statistics that are very clean and clear point to 2008 in terms of that stagflationary episode. You look at the Dallas Fed, its trim mean PCE inflation measure. The 6-month annualized figures at 2.6%. That's the highest we've seen since March 2008. Then you also have the University of Michigan consumer confidence. Within that, they have their next 12-month inflation expectations reading, and that's at 4.8%. In the month of October, and that's the highest we've seen since August 08. So clearly, there's some warning signs in the economy with respect to energy price inflation, cost push inflation generally. The offsetting thing to that, and I think you going back to this sort of keeping the recession word small on that mental whiteboard, and I think I'd love to hear your thoughts on this, which is consumers have $2.3 trillion on their balance sheet more than they did prior to the pandemic. That's a big number. And so I'd love to see how you sort of reconcile that with a negative outlook for the economy in the context of, having all this sort of, income support from a balance sheet perspective.
Yeah, it's not spread equally. That's the problem. I think the bottom 50% don't have much left. I think the upper 50% have been saving because they're thinking about retiring. They're a little uncertain. They're looking around. Maybe these are the business owners, the executives. They're just not sure. And the clock is ticking for them. I mean, a lot of them are really close to retirement. Yeah. So I think they're saving money. And then plus you can also look during the pandemic, if people just spent their brains out. I mean, they did that. I mean, it's like, well, how many more washers and dryers do I need to buy if I just bought one? Do I need to buy another car if I just bought one? And I think those factor in, as you mentioned, the University of Michigan, probably one of my favorite data series that comes out. I mean, if it came out every week, I'd be happy. I mean, I love that because it just tells you what consumers are thinking. And they're saying, look, I'm not spending, but why is that? I've always said, if you want to see money moving, give it to someone who doesn't have one, right? If I went down to a food bank and gave out $100 bills, would that money get spent by the end of the day?
Absolutely.
Guarantee it would get spent. Now, I go down to the country club, right, and I hand out $100 bills. I don't care. Like I'll just put it in my pocket with the other ones. Like it's
dabbing sweat with it and wiping their hands with it.
Yeah, and I think that's what we're seeing is we've seen this through the pandemic. Monetary policy benefited the wealthy. The fiscal stimulus benefited the wealthy in the fact that it helped those who didn't have keep spending and stay afloat. And so now we're at this point where I think the bottom half don't, if they have some money left, it's not much. And then when you're out of work, I mean, and anyone who's been out of work and been poor, it's even worse because whatever money you've got is not going to last long, especially with higher prices. And I think that's the danger I'm looking at, is people are looking at the upper 50% saying, look, that's all that matters. And in this economy, it's the bottom 50% that really do matter the most.
Yeah, and I think there's also a secondary component as well, not just with respect to the distribution of income cohort, the various income cohorts and people's marginal propensity to spend. I think you also have to look at it on what the heck do people want to spend it on, right? Like, so going back to people spending their brains on the pandemic, like, we all made our home office setups, perfectly nice, and got all the comfy clothes, and you basically bought everything that could make your sitting at home every day very enjoyable. I own 7 pairs of the same Nike shorts. They're incredibly comfortable. I love them. They're fantastic. I'm not going to buy an 8th pair. There's only 7 days in the week. You know what I mean? Like, and so that getting to my point, I really do believe, like, once you've consumed all the goods you really kind of want, you're not going to go much beyond that, right? Like, even if you have excess savings, you're still going to be like, well, I don't need the 8th pair of shorts. That's ridiculous. There's only 7 days in a week. And so I think we're probably getting to that frictional resistance as well with respect to the upside for goods consumption from here. And so we really do need the services economy to come on in full, or at least a lot more full than it has in thus far throughout this recovery process. And in order to sort of prevent that air pocket, because again, you have like fading goods demand, and you obviously have $2.3 trillion sitting in consumer balance sheets that may be allocated to incremental services. But the reality is, if we just don't get that supply of service like we expect, we're just not going to be able to consume the same level of services that I think a lot of economists and investors are probably thinking about when they talk about, looking into 2022 with a 4% GDP forecast. I think that's a pretty aggressive number. It's increasingly an aggressive number. I think I'm starting to see hear analysts and economists get their numbers down into the 3% range. Talking about 3 handles on 2022 GDP. But the reality is, if we don't get a sizable fiscal stimulus, and the reality is we know it's not going to be sizable just based on the shape of the negotiations down in DC, what's the real impetus for growth to be much more than trend growth? What's much more than potential next year? I'm increasingly starting not to see it. But again, I do believe the jury's still out, because I do believe the balance of risks on growth is still pretty balanced, because I do believe you could get a post-Delta bounce. If anything, I think that the real risk to growth deceleration is a mid to late Q1 event next year, at least according to our models.
Yeah, and you've got a lot that I really like there, and what it's ultimately going to come down to consumer spending, and we just don't know. I mean, that's the one variable that no model, no actual. We could have all the opinions in the world, but until we see people lining up and spending money in services, it's a dangerous game, because if they don't, then all of a sudden we're going to see layoffs. And that's something that troubles me, Darius, is I look at the weekly unemployment data, and it's still, averaging over 300,000. I know we've kind of broke that last week, but, so far we've been 50% above norm. And I look at this as like, all I keep hearing people like, well, there's a tight labor market. Okay, well, then why are people why? I mean, you don't get on the unemployment rolls if you quit. Yeah. You get there because someone says, I don't need your services anymore. So the question I'm having is, if employers now are still getting rid of people, how does all this translate into growth? I mean, I'd love to see that at 150,000 a week. If I was seeing that, I'd be like, all right, I'm seeing this, but at around 300, I don't know, man. What's your take?
I've given up looking at the jobless claims, to be totally honest with you. It's not that they're noisy; it's that they have so many mixed signals. Certainly with respect to the underlying labor market data we're getting from the BLS, there's a pretty meaningful divergence. There was at the early onset in the pandemic, and I would argue there's a somewhat of a meaningful divergence here. So to me, it's less of a signal at the current juncture than more forward-looking survey data looking at the NFIB data, looking at the consumer confidence data, looking at things like CEO confidence, and oh, by the way, the trend in corporate profits and corporate profitability, because I do believe that is also going to be a factor in whether or not those job openings actually transition to real time jobs here in the U.S. So with that, let's sort of transition the conversation. I thought we put a lot out there from the economic perspective, but as always, we're in the business of investing. We are not academic economists. We're here to help you make and save money. So even before we think about some investment opportunities as a function of your views, Steve, talk to me about how you incorporate all this, because there's a lot of information here. How do you distill it down into actionable trade ideas at Steven Van Metre Financial?
Yeah, that's a good question. So I've always said we're going to have a replay of the great financial crisis, and I've always believed it would be worse. And so I've looked back, and the two asset classes for me has been the dollar and treasury bonds, hence the kind of the bond king moniker. A lot of people ask me about crypto, and I just don't have any data to worry. If it was really popular like it was now back in 2008, I'd have a much stronger opinion on it, but I just don't. It's a variable to me. During recessions, I think what people overlook is it's a dollar shortage. I mean, that's what a recession is, just shortage of dollars.
Indeed.
And again, this is where I think people just haven't been poor before and had to sit down with their spouse, and you got your bills on the table and the kids are hungry in the other room, and you're like, well, here's all the money we got, and how are we going to carve it up? And there's where you start hearing these conversations of, well, don't we have some gold in the safe? Oh yeah, I got a couple coins. Or, hey, didn't you buy some of that crypto, whatever? Yeah, we'll go sell it, because we're not giving up the mortgage. We got to make the payment, we got to feed the kids, and we got to get through this. And I think that's what people often miss, is that during recessions is things that you have get sold to keep the stuff that you need. And that's my big question mark on cryptocurrencies is will they get sold to cover other bills? Don't know. Maybe they will, maybe they won't, not really sure. But what I see a reversal in crude oil coming at some point. I see gold going lower, not very popular, but you go back to the great financial crisis again, gold went down. I see bonds rallying. I think interest rates probably getting near zero. So I'm more of
on the long end of the curve.
Yeah.
Okay. What's the duration? That's a trade, my friend. When do you anticipate that coming to fruition?
Well, hence the should I put the crown on? Right. And I get a lot of flack for this because people, and if you don't mind, I'll kind of expand upon this. Is investing, isn't an inning to inning deal. For some people, it is. It isn't a base hit to base hit, or for me and other people, you have to look at your financial situation. Do you have a job? Do you have income? Where's your debts at? Where are you relative to your retirement savings goals? And the more of those boxes you start checking off, there's something that really interesting happens. Your risk adversity starts going like straight down. Yep. Because you're like, hey, I'm pretty good position. I just need to play out a couple of themes, and I'm game over. I win. And so I look at my situation as what is the highest probability bet that I know is still going to happen because the monetary system hasn't changed. And that's one of the bets going on right now is, hey, the monetary system has changed. It hasn't changed yet. In fact, until we get the long end to zero, monetary policy is still in effect. So my view is I love the long end of the curve. I think bonds are going to go straight up. And then at that point, you're going to have a massive risk off move. You're already seeing it in gold trending lower. I think gold gets down to 1,300 an ounce. I think gold mine stocks get obliterated. And there's your inflation opportunity. You sell your bonds and go buy into inflation sensitive assets. And if you don't like that and you say that's ridiculous, then hedge. I mean, that's when we talk about investors and making money and being smart, sometimes it's just not being over allocated to your thesis. And I could be a victim of that too. But, at some point, if you're bullish on Bitcoin or gold, have you thought about hedging in case you're wrong? Because that's the whole point. Why do we have insurance? Why do I have car insurance? And now that I work from home, I don't drive that much. But it's in case I go out and I get hit or hit something, it pays. And that's what your portfolio insurance says. That's why you hedge. Because let's say the worst thing is, and then I'm right, everything goes down and bond prices go up and you put a couple % of your portfolio in bonds. Guess what? You sell them and go buy more of that stuff you love. at a lower price. That's what the game's all about, is your time horizon. So I think my time horizon is a little bit longer than most people like, but I still know how the game ends.
Gotcha. Yeah. And so it's sort of parsing it up into time horizons. Do you think stocks are up or down 6 months from now?
I think they're lower. I mean, you see that in industrial production data. You see that in a lot of the other data that there's no way. I mean, and the bond market's telling you that. I mean, interest rates are kind of, slowly pushing lower. And what does that tell you? It tells you financial conditions are tight. Look at the dollar. It's at 94 or thereabouts. I mean, even the dollar's telling you there's a dollar shortage. So stocks are usually the last thing that goes. You want to look at the commodity space. You want to look at the bond market. Those tell you more of where the equity market is going to go.
Yeah, totally. I mean, I can't take my eyes off the compression in the 530s curve. I mean, to me, that's like you look at the, one thing we track pretty rigorously are Eurodollar calendar spreads to get a sense of, when does the market anticipate the pending, the eventual policy tightening cycle to commence, and how intense will it be in various years. And we went from basically pricing in almost barely one rate hike in 2022 to two full rate hikes like overnight almost, and what was interesting about that dynamic to me was those rate hike expectations were actually being borrowed from 2024. It wasn't as if we're just going to be hiking for longer and getting to a higher terminal Fed funds rate. That number is actually down if you look at 5-year forward overnight index swap spreads. And so clearly the bond market, the rates market, is sending a signal to investors that, hey, the Fed is going to have to take away the punch bowl sooner with respect to its monetary policy, its liquidity provision for both the economy and asset markets. And ultimately, when you look out 2, 3, 4, 5 years, the likelihood that we, one, get to a higher amplitude in growth, but two, more importantly, in GDP and nominal real GDP, but more importantly, the likelihood that we actually have to, shut down the process sooner than, investors or at least initially anticipating is actually growing. And to me, that's what's weighing on the long end of the curve. And you're seeing that curve compression, particularly in the 530s, which I think has been one of the more instructive moves of late. Going back to this, to your views on asset markets, trying to help investors kind of with the more medium-term time horizon, because a lot of what we're talking about is going to be irrelevant if you're a day trader. It's going to be, somewhat relevant if you're, super long-term investor, buy whole companies for 3-4 years, things like that. And so kind of getting it back to this medium-term time horizon. So you said gold's down, stocks are down, bonds are down. Thoughts on energy? Because it doesn't strike me that you're necessarily as bearish on energy over the next sort of, let's say, 6 months from now versus like a year from now. I think you think it's down. Is that fair to say?
Yeah, I think I would not be surprised if energy prices push higher. The only question is, does the economy reject it? Because, and I love to get your take, because I know you're the model king. I might be the bond king, but you're the model king. Is I look at, I think we'll both agree we're in a stagflation environment, and the broad view is we go from stagflation to some form of growth. But please straighten me out. Stagflation tends to lead to deflation. In fact, when I look at my data, I see that we're stagflation, but we got some toes in the deflation pool. We don't have them going the other direction. So to me, the probabilities go to deflation. I kind of, what do you see that from a model construction?
Yeah, no, that's exactly what we see. So at 42 Macro, we run two separate processes to both nowcast and forecast asset markets in the economy. So on the asset market side, we have what we call our market regime nowcasting process, which is akin to sort of, identifying what the weather is. What's the weather been? What's the weather at now? And right now, we inflation is what we call stagflation at 42 Macro in our grid regime process. And that is suggesting that you're correct. Stagflation is the current weather. I do believe the current weather will transition to reflation on the other side of that for albeit a temporary period of, let's call it 1 to 3 months. But then it's likely to your point, go to deep transition to deflation. And part of the reason I say that is because the bottom up macro regime process, that's effectively Google Maps or Waze. So what path is the economy going to take to get to the whatever destination that we're talking about in growth and inflation terms? And that path over the very near term, the next 2 to 3 months, is through stagflation. Stagflation is the highest conditional probability outcome for the U.S. economy